Hi guys, Guillaume here in this first educational video series where we are going to help you clear out some points that you might have regarding trading. And the first question that was asked to us is how to better manage our stop losses. So I thought I would make a whole point about stop losses in a very basic way of approaching them. We're going to use Bitcoin 1 hour chart to take an example. No indicators, no nothing on it, just we're going to take the basic fundamentals of the stop and why you should be putting it at some place and not another. So basically, always use a stop when you do trading. It's the most basic component of any trader. The stop loss is what prevents you from getting liquidated and giving your money to the broker, which is something you really don't want to do. It's the real last thing that you want to do is just giving the whole equity to the broker. There's many ways to prevent it, but still one of the questions that come often is like, why did I get my stop loss hit, or I lost too much, my stop loss was too wide? Well, it's exactly what we're going to see today. So the whole concept of the stop loss relies on the risk management technique, which implied something called the risk reward ratio. So basically it means that if you have, let's say you have a graph that goes like this and you want to put a short, you want to bet that it's going to go down, the amount of points that you're going to bet that is going to go down has to be bigger in size than the size of your stop. This is called the risk reward ratio. It means that over, let's say, 100 trades, if you're just right in 50% of the time, the fact that the gain potential is bigger than the risk potential will make that you will consistently win money over time, even if you're right only 50% of the time. This is something you will have to get used to, especially if you're a new trader. Even if you find a great strategy and you have a great edge, no one does 100%. I mean, it's already great to be 60% right most of the time. So what you really want to do is put all the odds in your favor and be more of a risk manager. See it every trade as a risk point of view. George will make an article, a text article about it also in detail. So the risk reward basically is what you want to focus on, not putting your stop too wide or too tight, depending on the risk and the reward. So what we're going to see, for example, here, me personally, I would wait for some downside here on Bitcoin. So I would guess there's going to be a correction after this huge impulse. For example, if we draw a fib retracement from the bottom to the top, we'll talk about fibs in another video, but let's say these three levels are important levels to look at, and me personally, I'm gonna aim for the 61.8. So I want my price to go as low as here, and in order to do that, I need to prevent it by of risking too much, and in the same time I need to let the trade go against me for a little bit of time, because if you put your stop too tight, there is great chances the trade's going to go against you at some point. The trade just doesn't go in your way straight away. It can, especially on long time frames. I mean, there is trades that I had underwater for 10 days that turned out to be good. It's really depending on the risk reward. So the size of the stop loss is going to define your risk reward, and then is going to define your position sizing and your leverage. For example, if you want to enter a short just here at the current stage, that means you have all of this as a downturn. So what you want to have is protect your gains in case things go wrong. So how to define where to put the stop? Where basically here you see that we have an area of resistance that has resisted already 3 or 4 times. And when you go on the bigger time frame, if you draw a fib retracement, just here, if you take this top and this bottom, you see that the orange line, the 78.6, see how the orange line, this one, is precisely around the area where we found resistance. So we can say, okay, this is good resistance. It's been going up quite a lot already. This has resisted, so it would be safe to put the stop in this area and Now the goal is to not put it too tight and not put it too far. A great tool that TradingView offers is the forecast tool that is right here, where you can enter a short position just by clicking here. So you take the actual. Before that, I'll clear the board so you will see better. All right. So basically, you click on short position. Let's say we enter. If we enter that at this precise moment, when you're gonna click, this is gonna appear. This is the calculator for your risk reward. At this point is at 1. You see the risk reward ratio right here is at 1. So we're gonna drag the profit up to our potential target, which is here on the orange line. And then you will see here that the risk reward ratio is 2.44. That means that if you're doing this on 100 trades, and if you're right only 50% of the time, let's say you bet 10 and you can win, for example, on the 10 you bet, you're risking $5, but your upside is 2.44 times up bigger than $5. So I don't know exactly how it is at the time. It's 12.2. Anyways, the fact that your upside is way bigger, your gain potential is way bigger than your risk potential, makes it safe in a long-term approach strategy to just practice. Here we have resistance level and Fibonacci extension. So if we put the stop around, let's say 425 right here, we have a risk reward of 2.5, and it's great. I would advise always to look for risk reward that are over 1.5 and 2 if you can. It's always going to depend on the setup, of course, but the goal is really to aim for the high risk reward without going too tight. If you go just here, the risk reward is 4, but you have a lot of chances of having it not going through. So you need to be just wide enough so that you have some room against the support and resistance zone. This is one of the key points. You should not place the stops straight on support and resistance zone, because these zones will be tested. Don't place them too wide in case the trade goes against you and you're just losing money when the trade could be stopped before. Number 1 rule is never move your stop if the trade goes against you. That means here is our position. If the trade goes like this and like this, maybe you're like, okay, maybe I will move the stop. No, you shouldn't do that. You should just let it either hit the stop or go into profit. But what you can do is when you start to see the trade going in your side from a certain level, let's see here we have 2 lows right here. If it makes a new low, let's say here, and it resists, then here you can move the stop that was here in profit, so you're securing a risk-free trade, and as long as it goes toward your target, then you just trail the stop and you move it lower and lower and lower, so that as long as it goes your side, if it ever pumps before your target, you secure the profit that you put right there. So that's basically it for the stop loss. Don't place them too tight, don't place them too wide. Never move them if it goes against you. Do not use arbitrary values for stop loss. Do not say I'm going to put it at 4.2 or 4.4. It has no sense. Use a stop that will invalidate your trade. Put the stop where your trade will not be right again, and then you will look for another setup. It's okay to be wrong, it's okay to be stopped. We got stopped many times. What we want to do is always have a risk reward that is nice, so that in the long run we're going to be profitable for sure. I hope this was clear enough. Please send us other questions or questions regarding this topic. We'll be very happy to help you towards your goal in trading. We're here for you. Community is essential. I wish you all guys a great day, and we'll see you very soon.